Good morning. It's Wednesday, the 27th of March, and this is Govindraj Ethiraj broadcasting from Mumbai, India's financial and also the fastest growing billionaire capital in the world. Our top stories and themes for the day before we come back to billionaires. Low liquidity hits major markets in a holiday-shortened week. What goes down must also go up, the China factor at work. India forced to switch to US crude oil as sanctions on Russia tighten. The Adani Group acquires yet another port, this time in Orissa. Mumbai is the fastest growing billionaire capital in the world. Can India choose between subsidies for manufacturing conductors and spending on higher education? And why chocolate prices will rise as global cocoa prices hit new records.
This is a core report with Govindraj Ethiraj.
Stock markets are gripped by low liquidity. The stock markets are on a slippery footing, as it was quite evident going into trade on Tuesday. One reason is liquidity. While in theory markets are open right now, in practice many investors are on holiday, including institutional ones. This means that there is less buying and selling overall, and in some stocks there may be very little activity. This was one of those unusual weeks with two trading holidays, Monday, that was day before, and Friday. On Wall Street, which in turn defines a fair bit of trading patterns and trends elsewhere in the world, it has been already projected to be a low liquidity week thanks to one trading holiday and long weekend, which is Good Friday onwards. So basically, don't expect too much. Equally, don't also read too much into price movements this week. On the Wall Street, stocks closed lower though. The BSE Sensex closed 362 points lower at 72,470, breaking a three-day positive run, which saw it gain about 821 points. The Nifty 50 fell about 92 points to close at 22,005. Meanwhile, the BSE MidCap index was up 0.7% and the small cap index was down 0.1%. Interestingly, some brokerages are already calling a bottom to the mid and small cap universe and asking investors to buy. Now, logically, it makes sense. I looked at a list of buys from one institutional brokerage. They included energy, finance, including the Bombay Stock Exchange itself, by the way, and technology, and they seemed like good companies. The point is that all small caps and mid caps were not bad, though they may have been overvalued. On the other hand, they were and are, I would presume, complete duds as well, which are unlikely to rise again, unless, of course, pushed up by mischievous investors, which is, of course, a most kind way to put it. So, bottom line, be careful. The rupee rose on Tuesday, and I may have forgotten to inform you that it had hit a record low of 83 rupees 43 paise on Friday. The rupee was 83 rupees 33 paise against the US dollar on Tuesday afternoon. When the rupee seems to be losing ground, the Reserve Bank usually steps in to sell US dollars to rein in further losses. In general, the rupee, as we all know, has been moving in a band, almost like a controlled band, though it has been slipping to lows or a weaker trading range. Overall, India's foreign exchange reserves are strong, having increased by about $6.4 billion to $642 billion for the week ended March 15th, according to the latest Reserve Bank of India data. In the previous reporting week, reserves had risen by about $10 billion to $636 billion. I reached out to Anindya Banerjee, head of research for Forex and Interest Rates at Kotak Securities, and I began by asking him what were the current forces of demand and supply at work on the rupee right now.
Actually, see, right now what is happening is we are at the final week of the financial year. And during such times, we tend to see a lot of changes in the demand and supply, which we don't see during the other times of the year. So it's a more of a seasonal effect. And what happened on Friday was that impact. So a sudden surge of demand from importers and some PSU demand for dollars, that led to a surge. And the market was anticipating that RBI will step in to sell dollars. That didn't happen. So a lot of the bank dealers were caught on the wrong foot. And that's a reason why the entire move that transpired on Monday happened after 3 p.m. because the spot closes at 3:30. So it is the 3 to 3:30 p.m. That's when the bank dealers, they tend to close their books. So a lot of them may have been caught on the wrong foot. Whenever a move happens in the USDNR market after 3 o'clock, generally it is due to some kind of a end of day position strike by the bank dealers, because that's the time you don't tend to see a large corporates come in. Generally, I'm saying there can be some days when there is an exception, but generally it was a book expiry. And then what happened was that once the spot closed here, the stop started getting hit in the offshore market and on the exchange. So it was just an accentuation because everybody was on the same trade that RBI will come and sell. They did not come. They came in, we presume, on Monday. That's when they may have intervened in the auction, and today as well in the morning.
Right. And as things stand today, going into the end of the financial year and the new financial year beginning, how are things looking for not just the rupee, but overall currencies against the dollar, Anindya?
See, the Indian rupee will be a little jittery because the elections are starting. This period of the election when we should see the volatility increase a bit. So that's something which will last all throughout the election till the results are up. But if I am going to look at next 6 months to 9 months, I think the global factors which we all watching is the US Fed when they start cutting rates and how much they will cut rates. That is something which will dictate what happens to the dollar globally. Now, apart from that, that another factor which is going to be very important this year, this calendar year, is going to be the inclusion of the Indian bonds and the JP Morgan bond index. The actual inclusion process starts in June. So it is expected something between 20 to $30 billion may come in due to the inclusion over the next year to 18 months. Already seen, I think, 7 billion odd come into the market over the past 3 months in the debt, and we could see that increase. So that will be a structural positive. But of course, the global dollar trend will matter a lot. That will be dependent on the Fed interest rate cycle.
And last question. So, broadly, if the Fed cuts interest rates as is being speculated and projected three times, let's say, what does that generally mean for the dollar? Which way will it drive it?
Actually, it's a very interesting question because if Fed was the only one who was cutting rates or who was about to cut rates, then it would have been an easy bet that, like what we saw end of last year, everything would have strengthened against the dollar. But now every other central bank is expected to move. So, in that perspective, what we are seeing is we will not see a lasting impact of an interest rate cut. Let's say if they come and hint again that they will cut in June, I think the next inflation data from US, which is on 10th of April, will be important in that regard. We will not see a lasting impact. It's not that just because the Fed will cut rates, we will see month over month sell-offs in the dollar. So dollar looks to be in a range. And a worst case scenario, internationally, it looks to be in a range. It can go up if there is some kind of a risk which materializes in the world, be it China or be it some kind of a geopolitical risk.
Right. Anindya, thank you so much for joining me.
Thank you so much.
India forced to switch from Russia to the United States for oil. India has been buying large amounts of Russian crude in the last year, also at lower rates because Western sanctions prevented Russia sending oil to many countries in Europe and elsewhere. Analysts that the core report have been speaking to have, however, questioned whether there was really a substantial price difference between Russian crude and international Brent crude prices because of transport costs and the like. Nevertheless, with sanctions being tightened further, the flow of Russian crude into India is slowing down even as India switches to other sources, including the United States. Reuters is reporting that more than 250,000 barrels a day of US crude is set to arrive in India next month, the highest in more than a year. So Reliance Industries is apparently the customer, bringing in 6 crude oil tankers with about 7.6 million barrels of oil, Reuters quoted ship tracking firm Kepler saying. India was a top buyer of Russian oil last year after other groups retreated from purchases following Western sanctions on Moscow following its invasion of Ukraine in February 22. The last month, the US added sanctions on Russia's state-owned shipping firm Sovcomflot and 14 crude oil tankers involved in oil transportation, said Reuters. So, Reliance will not buy Russian oil loaded on these tankers operated by Sovcomflot, according to Reuters, adding that other Indian refiners, which include government ones, may also not bring in oil through these tankers, which obviously reduces the options Russia has to dispatch the oil. Meanwhile, Brent crude prices were quoting under $87 a barrel, still high but steady in recent days. China's $1.75 trillion rebound. Now, for several months, we've been reporting how foreign portfolio investors have soured on China and were pulling out funds and moving them to markets like India and Japan, among others. Now, the capital exodus had several knock-on effects, including a fall in the overall market capitalization of Hong Kong and an increase in India's. Hong Kong had seen a 4-year fall until 2023 and then lost another 10% at the start of 2024. India had then overtaken Hong Kong to become the fourth largest market in the world by market capitalization. Now, Hong Kong is a small country, but its stock market and Hang Seng Index mirror and host several mainland China stocks. Now, the tide is turning once again. For one, Hong Kong has regained its spot as the world's fourth largest market, and India's overall market value has fallen by some $180 billion from the March 4 peak of $4.75 trillion, according to Business Standard. Now, the fall is largely thanks to the beating that small and mid caps have been taking, which the benchmark indices like the Sensex and Nifty do not either reflect or fully capture. So right now, the Chinese territory's market capitalization stands at about $4.9 trillion versus India's $4.75 trillion, according to Bloomberg data. Now, the Nifty Small Cap 100 index has slumped more than 14% from its record high this year, while the Nifty Mid Cap has fallen about 7%. Meanwhile, the South China Morning Post is reporting that foreign investors have invested some $8.4 billion into onshore listed stocks in February, ending 6 months of outflows, according to the HSBC. Moreover, some research firms are saying that the $1.75 trillion rebound in Chinese equities listed in mainland China, Hong Kong, and New York since late January is only the beginning and will get even better. The MSCI China Index, which tracks more than 700 Chinese stocks listed at home and overseas, has risen by about 14% from its low this year, making it the best performer amongst major world indices in that period. So the question, of course, is or could be, what does this mean for India? Well, actually, nothing much, because there is no change in the India story, at least in the eyes of investors. And those who will move back to China will do so with fresh funds or move them from elsewhere. The same foreign portfolio investors who are calling China's bottom also remain bullish on India's medium to long-term prospects, even if they find valuations stretched for now. So the moral of the story is more to do with the assumption that China was not going to bounce back in a hurry or would be in the doldrums for a long time. I'm talking of the markets, of course. Discussing the underlying Chinese economy will take much more research to unravel. Or to sum all of this up in one line, what goes down must go up too. Why Indian banks' cost of capital will go up. Speaking of things going up, the Reserve Bank of India's increased scrutiny of banks and non-bank finance lenders will improve governance and curtail exuberant lending, or for that matter borrowing, but may raise their cost of capital as well as slow down loan growth, S&P Global Ratings said on Tuesday. In November, if you recall, the Reserve Bank had tightened its norms on unsecured loans and warned lenders against all forms of exuberance. Reuters reported last week that the Reserve Bank is diving deeper now, targeting new areas of retail lending, including mortgage-linked top-up loans. And of course, it's been hauling up non-bank finance companies, one of whom was evidently playing fast and loose with its gold loan portfolio. Banks give loans on the basis of gold deposited with them as collateral. Banks give loans of up to about 75% of the assessed value of the gold that is given to them. The gold has to be in the form of jewelry and must be valued properly. The problem, it turns out, is that the valuations were wrong, the due diligence bad, and the gold was not the gold that it was promised to be. For example, what was offered as 24 karat gold could turn out to be 22 karat or 18 karat, or came with some impurities and essentially lower value. Now, all of this came to light when the loan takers defaulted and the banks tried to sell the gold. The increased focus on compliance combined with tight liquidity in the banking system will slow down credit growth to 14% in 24-25 from 16% this financial year, S&P estimated. However, Fitch Ratings said in a separate note that Indian banks' profitability is likely to stay resilient despite the pressure on margins. Fitch expects banks' net interest margins, or NIM, to narrow by 10 to 20 basis points over the next 2 years amid rising funding costs, given the competition for deposits, reported the Business Standard. All of this does not seem to be really a problem in the medium to long term, and it's likely the regulator could ease up if it felt the tightening was working and, of course, restoring some sanity. Meanwhile, S&P Global also raised India's GDP growth forecast for financial year 24-25 by 40 basis points to 6.8%, though it's lower than what the central bank and the government have projected at 7%. S&P also expects India to grow at 7.6% for this year, that's 23-24. All of these projections were part of a report called Economic Outlook Asia Pacific Q2 2024. APAC bides its time on monetary policy easing. Mumbai, the land of billionaires. Mumbai has become the fastest growing billionaire capital in the world, adding 26 such persons and taking it to the third rank in the world. Mumbai has also now overtaken Beijing as Asia's billionaire capital for the first time with 93 members in the exclusive Rich Club according to the Global Rich List 2024 published by Hurun Research Institute. According to the Shanghai-based institute, New York and London lead the cities with 119 and 97 billionaires respectively. Meanwhile, New Delhi also made it to this list for the first time ever. Hurun's Global Rich List wealth calculations are a snapshot for the year ending Jan 15, 2024, and this is its 13th edition. In all, India added 94 new billionaires in 2023, taking the country's total to 271, and now they represent a cohort that has a combined wealth of about $1 trillion, said this report. Reliance Industries chairman Mukesh Ambani is the only Indian to rank in the top 10 of this 2024 list. Ambani, who is 66 years old, is placed 10th and was worth $115 billion in the period the report tracked. That also makes him Asia's richest person. Adani Group chairman Gautam Adani ranks 15th, and he is the next Indian after Ambani. Apart from New Delhi, which broke into the top 10 cities for the first time, Palm Beach, Istanbul, Mexico City, and Melbourne also broke into the Hurun top 30 cities. Pharmaceuticals, automobiles, automobile components, and chemicals industries were some of the country's sectors that dominated this list of billionaires industries. China, by the way, tops the list with 814 billionaires, but its list has shrunk by 155 from 2022 thanks to turmoil in the stock markets, real estate, and renewable energy sectors. The United States comes second, actually, with 800 billionaires, but it added 109. Many of the new billionaires in the United States, not surprisingly, were linked to artificial intelligence. Adani ports expand further and east. Adani ports have bought another port in Gopalpur in Orissa, this time from the Shapurji Pallonji Group. The Pallonji Group itself had sold another port earlier, being Dharamtar in Maharashtra, to JSW Infrastructure for about 710 crores. The Pallonji Group had acquired both ports between 8 and 9 years ago and have sold them again now. Adani has grown from one port in Mundra in Gujarat to become the country's largest operator with over 14 ports and terminals handling a quarter of all cargo passing through Indian ports. Most of these ports have been acquired, like the latest one, and Adani now has a presence every 500 kilometers on an average on India's 5,400 kilometer coastline, an investigation in Indian Express in October last year had pointed out. Should we spend on chip making or higher education? Yesterday, we deep dived into the global race for semiconductor investments and how countries like the United States were quite literally showering tens of billions of dollars of tax breaks, incentives, and subsidies for setting up semiconductor plants to companies. Intel is investing almost $100 billion right now, of which close to half will come in the form of federal and local government tax breaks and subsidies and incentives. Now, India is in the race too, offering similar incentives, though smaller. The question, of course, is can it afford it? Former Reserve Bank of India Governor Raghuram Rajan said yesterday that the policy choices made by the government to spend more on subsidies for chip manufacturing than the annual budget for higher education were misguided. The subsidies to semiconductor businesses to set up operations in India was an estimated $9.1 billion or about 76,000 crore rupees compared to about 47,600 crore rupees allocated for higher education, he said in an interview quoted by Bloomberg. Rajan's point is that the government should fix the education system so it can produce well-trained engineers needed for those industries. Now, the problem, of course, is that chip manufacturing is now akin to defense preparedness, being precisely the reason why countries are racing to set up capacity and also de-risk from China, or for that matter, even Taiwan. India is in the same race and has little choice but to be in it from all accounts. Tax breaks and subsidies are, however, both federal and state-led, and India has to decide which states can bear the burden of big-ticket incentives and which can't. It's quite clear that traditionally industrialized states like Gujarat, Maharashtra, Tamil Nadu, Karnataka, among others, can bear a greater load of subsidies in the case of chip making than other states in the country. India's moves on this front must therefore be more carefully calibrated because the chip race is like an arms race from which you cannot exit. Cocoa prices hit record highs, chocolate could follow. If prices of almost everything are rising, how far could chocolates be? Cocoa futures surged above an unprecedented $10,000 a ton, extending a historic rally that's already seen prices double this year, and which of course is raising the price of chocolates, according to Bloomberg. The reason is poor crops in key West African growing countries that has put the world on course for a third straight annual supply deficit, Bloomberg says. Bloomberg says the industry is grappling with the legacy of poor returns paid to cocoa farmers and fears are mounting about being able to source enough beans, adding that high cocoa prices is bad news for consumers if chocolatiers keep passing on costs or sell bars that are smaller or have less chocolate in them. And that to me sounds very familiar. Focus is now turning to West Africa's upcoming mid-crop, the smaller of two annual harvests, and countries like Brazil and Ecuador are meanwhile trying to ramp up production, but it does take a few years before newly planted cocoa trees bear beans. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.